isolated sector. Now, in 1980, you had a bubble in gold and in silver and in oil, but the bond market had been going down throughout the 1970s, with government bond yields increasing from 6% to over 15% in 1981. So normally a bubble is in one sector or in one region of the world. Like in 2000, we had a bubble in the TMT sector, technology, media, telecommunication. But you didn't have a stock market bubble. Steel stocks were depressed, commodity-related stocks were depressed, commodity prices had been going down since 1980. And you didn't have a bubble in, say, shipping companies and anything that was old economy stocks, so one sector. But Mr. Bernanke and Mr. Greenspan have achieved what nobody has achieved ever before. They created a bubble in everything. Real estate globally has gone up, stock prices globally went up, commodity prices went up, even bond prices continued to go up. In other words, interest rates continued to go down on bonds until 2007. Art prices everywhere in the world went up, and even totally worthless collectibles have gone up in value. And you can see this is an index of different asset classes: bonds, equities, NASDAQ, S&P, and so forth, commodities, and dollar inverted. There's only one asset class that went down since 2002, and that was the US dollar. So now, my view is this. Normally, when a bubble bursts, say Japan after '89, it gives a very clear signal that something has changed in the economy. When the gold and silver bubble burst in 1980, it signaled that inflation would no longer be a problem. Now we have a bubble in everything, driven by credit, well understood, easy monetary policies and credit. And as I shall demonstrate, the credit bubble has burst. And so my sense is that this bubble in everything is now going to be deflated, as it has now over the last 12 months, and that actually maybe the US dollar will kind of appreciate or relatively appreciate. In other words, cash will appreciate. So this is important to understand. Now, in America, and every bubble has some sectors that inflate more than others. Say 2002 to 2007, emerging markets went up much more than the US market. This is understandable, and the market was quite rational, because the emerging economies are essentially like warrants on the US economy. They're much more cyclical than the US economy. So during a boom time, the emerging markets went up the most. Also, real estate in America went up more than, say, equities. And you can see here, this is an index of real home prices in the long run. They move up very gently in real terms. Real terms is inflation adjusted. Then here we went way above the trend line, and recently we're down 20% from the peak. I concede that in some areas like San Diego and in some markets like Florida and Phoenix, also Las Vegas, prices may be down 35% already. But the 20% decline here in home prices basically is not a big decline. The problem is not the 20% decline in home prices. The problem is the leverage in the system. If you own your house outright, you have no mortgage. What do you care if your house is down 20% in value or up 50% in value? It's still the same house. The problem is if you finance it with 120% credit in the expectation that the house price would continue to appreciate and that you could repay essentially your loans when selling the house. That is the problem, the excessive leverage in the system. But the American policymakers do not seem to understand. Now, number one, other markets than the US have even more inflated housing markets like Spain, Ireland, Australia, the UK, and so forth, and they are even more vulnerable than the US. Secondly, the big question we have to address, and I don't have a precise answer, is Home prices are down 20%. They're still in real terms up here. Now, how will the housing market perform going forward? Will the Federal Reserve, that is now flooding the system with liquidity, and the Treasury, that is increasing the fiscal deficit, will they be able to support the housing market here in nominal terms? In which case it is possible that the housing market is bottoming out here around this level in nominal terms. But because of the flooding of liquidity into the system, I would imagine that consumer price inflation will at some stage accelerate, and then home prices will deflate in the long run in real terms. Let's say home prices appreciate by 2 or 3% per annum in nominal terms, and the rate of inflation is 6%, then obviously you have a depreciation in real terms of around 3% per annum. So the adjustment, in my opinion, will either be swift and strong through nominal price declines or further declines, or very lengthy that in real terms home prices, because of the oversupply, don't perform well. But in either case, it won't have a favorable impact on real economic activity. Now, I explained that during the period 2004 to 2006, during which the Fed was increasing interest rates, lending standards were eased, and that therefore we never had tight monetary policies. Now the opposite is taking place. I have shown you that the Federal Reserve has cut the interest rates from 5.25% on September 18, 2007, now down to 1.5%. But the private sector is tightening monetary policy, because during this period of declining interest rates on the Fed fund rate, the private sector has tightened lending conditions very considerably. Bank credit, as you see, is going down. Actually, right now, bank credit has just turned negative. Consumer credit is down. Commercial paper outstanding has declined. And we have an unprecedented collapse in total debt growth in the economy. Now, I explained that the period 2001 to 2007 was characterized by accelerating debt growth that drove economic activity. By lifting home prices, it allowed households to extract equity from their homes, refinance their mortgages, and go and buy a BMW or a Mercedes car. Now, this credit growth has come to a total collapse, and that will have, in my opinion, very dire economic consequences. The economy is in recession, and it will not come out for quite some time, because I doubt that credit growth can be reignited even by the Treasury and the Federal Reserve to this growth rate that peaked out here at the 16% annual growth rate. Now we're down to something like 3% growth rate, and that will have, obviously, as I mentioned, unpleasant economic consequences. Now, the US is in recession. In my opinion, the recession began actually already last October, but I shall explain why government statistics still show positive growth rates. The real economic indicators, say inbound container traffic at West Coast ports, which indicate the number of goods that are imported in the US, in the first 6 months of this year were down 8% year on year. The truck